Cool. Well, welcome to the SumZero podcast. Today we've got two former quants actually from Millennium, a very large hedge fund here in New York, and both Jason and Ryan kind of have an interesting mix of quantitative skills and also fundamental skills investing. I think you guys have kind of covered both the tech sector and other sectors. From both perspectives, and I know Jason, you actually have a degree in natural language processing and other kind of artificial intelligence programming skills that you've sort of used to parse through the markets and understand the markets better. What I wanted to talk about today, obviously the topic is AI. It gets thrown around a lot as a buzzword, and I think in the investment world, I get a lot of questions actually from both clients and just folks who follow the markets on, how are quantitative techniques being incorporated into the markets and in investing. How is fundamental investing evolving, and you also see this buzzword Quantamental being thrown around a lot, which sort of indicates the combination of fundamental and quantitative techniques. And I think for a lot of people, they scratch their heads and they wonder, what does all this mean? And, how does it relate to them? I think now more than ever, it's become an even more important topic of conversation. We just saw, obviously, what happened with WallStreetBets and the whole GameStop fiasco in terms of, sort of seeing the convergence of investing communities, and the markets, and also the professional investors out there who have historically and continue to have a major role in the markets. We at SumZero have for a long time, been a part of this movement of creating, or rather connecting individuals with common interest. In our case, it's professional investors, and using those connections to better screen for investing opportunities in the markets and to make sense of all of the data that's out there. And I think what you guys are doing is really kind of at the cutting edge of, again, how to screen for ideas amidst a lot of noise and a lot of data. And parsing through that, I think, is becoming more and more complicated. So with that, I'd love to hear from you guys, just as sort of a starting point on, you just kind of maybe describe your backgrounds a little bit, but also how you've seen artificial intelligence evolve and how it's become, more integral part of the investment landscape, and looking back at your experiences at Millennium, kind of what opportunities you guys saw there, and where you guys see this technology kind of taking us going forward. So maybe that'd be just kind of a helpful start to frame the conversation.
Yeah. So like you mentioned, Ryan and I worked together in a tech portfolio at Millennium, and I think it actually skewed much more fundamental than quantitative. I was kind of brought on as a data scientist to capture this wave, also like you mentioned, the Quantamental wave. Like how do you bring these new quantitative and data science approaches to the fundamental investment landscape? And that's been kind of a huge question over the last few years. And a lot of funds are just throwing money at what they're calling big data, trying out different strategies. But I think the reality is there isn't one good strategy that has, clearly worked yet. Generally speaking, I think up until now, quantitative has been on a shorter time frame. Specifically, it started like high frequency trading. You really need to be quick and have quick algorithms. And that sort of duration and investment time horizon has been lengthening where the quant approach can work. I think likely because you need less data now.
Yeah, I think that's right. And I think it's really interesting how a lot of folks in the analyst community have been trying to figure out how this technology applies to them in a longer time frame. When you're trying to figure out what's a good 12-month bet or a good 24-month bet, trying to assess how, quantitative tools actually can help in that regard is a little bit more unknown, I think, than some of the high frequency stuff you're talking about, which also tends to get extremely noisy. I think when folks invest on very short time frames, there's arguably a lot more noise. So what's interesting is, I think, first, in order to make some of these tools work, you have to give them good data. And I think what's special about the data set we have on SumZero is that, it's coming from professional investors only. So we have, over 16,000 members globally. And the subset of that community that's posting content, they're typically writing reports that are often, a few thousand words long, if not longer, and contain timeframes that, trading timeframes that tend to be longer than 6 months, oftentimes multiple years, with price targets that reflect longer term viewpoints. And so you don't often see somebody on SumZero share an investment idea where they think a stock is going to go up 5%, over a week, but they're really predicting a stock going up, maybe 20% to 100% over the course of, 12 months or longer. Can you just speak to, I guess, the data set itself and how it, why it attracted your attention and why you thought this data set would be a good candidate for some of the AI tools that you've been using to filter through that data set?
Yeah. I mean, typically the workflow for these like Quantamental shops is you take the quantitative approaches, you take machine learning algorithms, and you use that almost as a filter for the fundamental analyst to choose from a potentially better subset, a better universe. I think it should be flipped around. Like, that's all backwards. It should be the fundamental analysts and their rationale being fed into the quantitative and the machine learning algorithms. When you use an algorithm, you create, a sample, but then when an analyst picks out of that sample, they're almost ruining the properties that the machine learning algorithm had in mind. So when you flip it on its head, it specifically works well with SumZero data. Maybe we should take a step back and just talk about what machine learning is.
Sure. Yeah, I think it's a good idea.
And then how we're thinking about applying it to the SumZero data set. But I like to explain machine learning as calibrating to reality by understanding prior ground truths. So you're given some data set with a bunch of prior examples, and you also have the outcomes of those examples, and you want to find an algorithm that will make decisions on future data that most likely get you to your desired outcome. So now, how do we apply that to SumZero? We have this, vast data repository of write-ups that go back to 2008. I think it's something like 15,000 write-ups, and we have the outcomes of those write-ups. Did they outperform the market? Did they underperform the market? And we have all of the fundamental data and the natural language that goes together with those write-ups. So we can build a model that takes a new write-up as soon as it's posted and say, okay, well, what's the likelihood that this outperforms or underperforms the market over some predefined time duration?
And how do these models differ from, traditional regression models, linear regressions? Like, what is it about these AI tools that gives them an edge over those models?
Yeah, I mean, at its core, almost everything is built upon linear regression, but the newest models, and we can talk about natural language processing too, but the newest models are really finding sort of nonlinear interaction effects between all of these various factors. So it's not just, weighting heavily towards value and picking low price to book names or something. It's examining the interaction between a low price to book and other factors that are going on at the same time.
Yeah, I think the that interaction effect can obviously seem a little bit like a black box to someone on the outside. Um, you know, you take a bunch of data, you put it into this box, and then it tells you, what stocks to buy. And that sounds easy enough, but it's a little hard to maybe buy into that conceptually and philosophically. Can you unpack what's in this black box a little bit? With you don't need to get into the minutia, but just at a high level, what are the factors that are going in to the model, and then how are those factors being processed to create an output that we can make sense of and use?
Yeah, so we're kind of starting with our financial domain expertise of having the fundamental experience already. So we know what factors we would look for as fundamental analysts, and we feed those to the machine learning algorithm. So we look at things like free cash flow yield. We look at how the stock has performed versus an index, maybe 6 months before it was posted to SumZero, a year before it was posted to SumZero. We look at all sorts of things, earnings, estimate revisions, sell side price targets.
Right.
Yeah.
And in total, you might be looking at 100 different factors, if I have it correctly. And so what is the model telling you? I mean, is it giving a heuristic essentially on what's going to happen? I guess maybe one way to think about it is a best guess of sorts. How would you describe what's coming out of that model?
Yeah, that is how I like to think about it. I think of it as, well, I think of the whole process as like this quantitative filter, which is the algorithm, over qualitative rigor, which is the analyst's write-up in SumZero. And so you first get this write-up, and someone's already performed, a lot of qualitative rigor on it. And this quantitative filter, I do think you can think of it as like a heuristic, because we look at why the model is making a decision. A lot of people think machine learning algorithms are black boxes. And I think the truth is, over the last couple of years, there are tools that make that not the case. You can really see why a model is making a decision. And when we look into our SumZero models, we see that the model prefers companies that have a high free cash flow yield, that different interactions with momentum. Maybe it likes a company that has high 3-month momentum, but if that company has a low free cash flow yield, it would like it less than if it had a high free cash flow yield. So that's where the interaction effects come in. And we haven't spoken about the natural language processing side of things, which is pretty important.
Yeah, and maybe to take a step back, the reason that's relevant to us at SumZero is because people are producing these reports. They're not just saying, buy NVIDIA at this price because we think it's going to go to this other price, but they're actually providing a rationale to justify their price targets. And a human's going to read that report and interpret it in an individualized way, based upon their own biases and their own investing framework. How does natural language processing do it? And you might want to start from the beginning here, because some of the technology with respect to NLP has really come a long way. But sort of where did it start? And then we can get to how we're using it at SumZero. But if you can give us a little history of NLP, that'd be great.
Right. So NLP, natural language processing, is just a subset of machine learning. It's doing that same process I described earlier, but it's doing it specifically on text data, or speech data, but we'll talk about text. And I think probably the best thing for people to relate to is GPT-3. That's kind of been in the news. I think most people have heard of it, but it's a generalized language model that can do a lot of things. It can extract information like what people places things were in a sentence or a paragraph. It can learn sentiment. So about movie reviews, it can say whether a movie review described the movie positively or negatively. And just generally, it's a step towards computationally understanding text, which I think means just extracting value from the raw output of sort of online communities, exactly like SumZero. And that's kind of the exciting application here.
And how does it, I guess, codify language? So when it's reading a sentence, does it, I mean, how does it know what the subject is, what the verb is, what the object is? And then how does it, I mean, how does it know what a qualifier is and, you know, the degree to which somebody may or may not have conviction on a specific statement they're making? How does it actually codify all that?
Yeah, that's a good question. And that kind of hits on like the development of NLP in the last few years. The start and like the crude version of NLP, which was only maybe still happening 4 or 5 years ago, you would chunk up the document into words, and each word would be its own sort of feature to the algorithm. Um, More recently, these language models like GPT-3 are not looking at words on their own, but words in relation to other words in the sentence or in the paragraph. So in the background, what's going on is you're turning these words into numbers, and then you're learning the relationship of these numbers in space. So you can think of it as semantic reasoning. It's not reasoning in the sense that humans do by any means, but you can learn the difference between a place and difference between things. And also, like you mentioned on qualifiers, like one of the crude NLP models, if there was a movie review that said it's not good, maybe the model would only pick up good and it would think it was, positive sentiment. The newer good models can now realize the not is negating good.
Right.
And that's kind of an example of how these things are getting better at understanding the information contained in a write-up.
And GPT-3 is how old? When was it launched? Who was it launched by? And who's using it now, out of curiosity?
Yeah, GPT-3, I think it's still in beta, but they're going to launch it as an API, so anybody can use it. And it's a good sort of like general task agnostic NLP tool that can do a lot of different things. So anyone will be able to use it soon. It was released by OpenAI, which is like an AI research center. That's the one funded by Elon Musk, and it gets some headlines around that. But
it's ironic because he's also very public about just being terrified of AI.
exactly. Well, that's why he has to fund it. So
Yeah.
when we figure out general intelligence, it's done safely and under his watch.
Right.
Yeah. But they're doing some really cool things. They have some newer models that you can like describe an image and then the image will just pop up. It's amazing.
Yeah. Well, I think what was interesting was the ability to not only interpret text but also to create text. And I was just
we generated some write-ups like on Tesla, and it's eerie how it's like making an investment thesis. And it's definitely not perfect, but it's getting there. And I think our intuition there is, to the extent that you can generate a write-up, you can almost certainly understand the contents of a write-up as well. And again, not like a human, but you can take out facts like, okay, the write-up is talking about a management team, and it's talking about the management team in a positive light. So that's
right. I mean, it's funny. I mean, even today I was on LinkedIn and I was responding to a message, and they offer you an automated response, which you also see with Gmail. What level of natural language processing are they running in order to auto-populate something simple like an email?
Yeah, it's very similar. It's basically the same tech behind the
Same
scenes.
technology, yeah.
It's a language model, and all these things are really doing are they're predicting the next word in a sentence. And so that's how it's being generated. But by being able to predict the next word in a sentence so well, you have these emergent properties where you can also, again, like you can extract information at the same time. It's
Right.
learning so many different cool things about language just by being
So,
able to.
so in theory, if you gave an NLP algorithm a few data points, let's say they were around, let's bring this back to stocks and investing. If you gave that model, a few fundamental data points, maybe it's sales growth, margins, free cash flow yield, something to that effect, something about the competitive landscape, could it in theory come up with its own investment memo or recommendation based upon a fairly limited set of data?
Totally. And that's, I think, what's so cool and exciting. It's like, and what you're touching on there is what's called multi-modal learning, because it's using multiple modalities, multiple types of data. You're using, fundamental financial data, and you're also using text, but you can combine the two. And while it's generating the text, it can reference the financial data that you've provided it.
Right. I mean, that's just crazy to me. So you could be reading an idea and have no idea that it was written by a machine and not an
Right.
actual.
Yeah, I think we can provide you with examples that you wouldn't know. And again, they're not perfect, and it'll probably take a few more years before it's
Yeah.
real. But like, I can see this disrupting equity research reports, no problem.
Right. Right. Yeah. I think that the big leap is going to be whether or not that content is fully thought through and predictive or not. Like is it going to be accurate or not?
Right,
Um,
fair enough. It may just be like an initial tool. I think we were all like on the sell side at some point, and it would be what I think would be a great tool is like on an earnings night, we have this language model. It reads the earnings report. It generates a report for clients that then I can go into and edit. But it will have auto populated like earnings was XYZ up
right.
X% from last quarter, and then I just have to kind of fact check it. But
Right. And maybe you have a viewpoint that's not expressed and you can add that in, but it would certainly speed things up. Because a lot of these sell side research reports, especially after earnings, tend to be, they follow the same format. Well, so and so beat expectations by 10%. Sales missed whatever expectations by Y%, and here's what management had to say about their stock buyback program and guidance for the next quarter. That would be incredible if that becomes fully automated. In the next couple of years, if not in the next decade. So, with respect to SumZero, we have this incredibly unique data set. We've had it for quite some time. We've got kind of a track record at this point. What we're kind of thinking about is using all these new tools to help our members screen for ideas. And one way in which we're doing that is through creating baskets, what we sort of think of as best ideas, leveraging all these AI tools as well as maybe some of the NLP tools. What can you say about some of the work you guys have done from a basket construction standpoint? What are you seeing in terms of looking at the SumZero data set itself that you think is interesting from a quant standpoint and could be leveraged by investors down the road?
yeah, so like I mentioned, what's great about the SumZero data set is it allows us to have that pipeline of putting fundamental analysis through the quantitative filter rather than the other way around. So we look at the SumZero data set, we download all of those financial factors, we look at the text contained within the write-up, and we build these machine learning models that try to predict whether an idea will be successful. And over time, we add that to these baskets. So we have I think about 4 right now. Best ideas basket. There's a tech focused basket, North American, and SMID cap. And all of those different baskets are learning on different subsets of the data to try to optimize for different things. The best ideas looks at all of the data. The tech focused only looks at tech names, and they learn different things based on the sample that they're learning from.
And what have you found so far in terms of just results, in terms of how that, obviously you've back tested the data set. What have you seen so far from a result standpoint?
Yeah, I mean, so we've trained on data from like 2008 to 2020. That's kind of our in sample period. Our out of sample period is 2020 until now. And at least for right now, we're trying to optimize outperforming the S&P. And from 2020 until now, the best ideas basket, each idea in that basket on average outperforms by close to 12 to 13%. It's outperforming the S&P by 12 to 13%.
And how many names are in that basket, roughly?
I think it's about 100, 110 from 2020 until now. The other baskets have fewer names just because it's on a smaller subset of the data, but they have similar performance. I think actually like the tech focused and the SMID cap are doing much better.
Yeah, that's incredible. I mean, I guess that's roughly at least directionally aligned with what we saw happen in the broad markets last year with coronavirus. But you could, in theory, blindly follow this basket. I'm assuming, or rather, I'll ask: are all of the names equally weighted in that basket, or they're just equally weighted? So you could just blindly follow what's in the basket. You would have been up massively over S&P 500 returns for all of last year, which I think is incredible, especially given that the S&P 500 is historically a tough index to beat for any traditional money manager. That's amazing. What are you seeing, having worked at Millennium and kind of being plugged into the industry, how are some of the biggest funds in the world thinking about all this, and what kind of tools are they leveraging? Where like who are the innovators here? I'm just, if you were to lay them out.
Yeah, I mean, you have the typical quant funds who have been doing stuff like this for a while. You have the more fundamental focused funds who are just still onboarding and figuring out how to use the quant techniques.
Like they're pretty far behind the fundamental shops on a lot of this technology.
Yeah, and they seem to be switching strategies because things don't work. And I still believe it's just because they have the problem flipped the wrong way around. Like I've mentioned a couple times, you need to have the quantitative layer being the ultimate layer, because otherwise you're just ruining the distribution that the algorithm had in mind when it picked its ideas. But generally, it's also different than what we're doing here with you guys with the basket ideas, because the quantitative techniques suppose that there's a predefined universe. Let's say you have a universe of 5,000 stocks and you have data for all 5,000 of those stocks, and you're reevaluating every day or every week or whatever your rebalance period is. But you're kind of chained to that universe. Whereas what's cool with SumZero is you don't know what idea is going to come in tomorrow, but the process is still quantitatively figuring out if that idea should be added or not.
Right. And
Right?
and the challenge, I guess maybe the challenge of using these tools is what? Is it is it choosing which factors you want the model to opine on, or something else? I mean, I know with our model, there's nearly 100 factors that are at play. Could anyone just go in and reverse engineer the basket, or where's the I think some of the judgment come in, some of the human judgment come in on configuring the model to actually produce something that's useful and create the alpha that we're looking for?
Well, I think the first hurdle is on the data side. So first, let's like assume you have the SumZero data feed,
Right.
because you need a fair amount of data to train this stuff still. I think there are some funds that they have alpha capture systems where they'll take in sell side reports and do something similar to what we're talking about.
Mhm.
That just seems a little broken to me. It's like a pre-internet strategy. Whereas SumZero, you have this online community, it's crowdsourcing ideas. You've already broken like the fact that sell side reports have misaligned incentives. You're getting just more data from a wider distribution. And so that's probably the first hurdle. But if you have the SumZero data, I think you can build models similar to this. I mean, so when we were building these basket reports, we wrote this white paper with you guys, and I think that explains things pretty well. If someone did want to try to replicate what we're doing, it wouldn't be too tough, and maybe people should try that because they'll learn different things. Well, yeah, we're using about 100 factors and using the natural language processing, but maybe a fund wants to use other factors and maybe they want to do it.
Or they want to plug in data that
Yeah,
we're not using in our
exactly. Or maybe they want to do it over a different duration and they want to optimize versus a different benchmark. I think that there are like an infinite number of different variations of these models you can build just based on what you want to optimize for.
Yeah.
And yeah, we're hitting on a subset and we're building the different baskets to try to get some of those. But I think a quant at most of these shops can try to replicate these.
Right. Right. Yeah. I mean, I guess if you have basic infrastructure around, being able to plug into some of these APIs and if you have access to data sets that you deem to be useful, to be able to combine that with the SumZero data set and then run it through an NLP model could be a pretty productive exercise. I think I think that's a pretty good summary of at least what we've been doing. Jason, as you said, we have this white paper that I think explains a lot of this in greater detail, and we'll certainly disseminate it further. But unless you have anything else you wanted to add about this new frontier, I think I think we can call it, and hopefully we can catch up again to sort of see what maybe the next iteration of this modeling looks like, and maybe talk more about some of these baskets down the road.
Yeah, no, I think we covered a good amount. I'm trying to, maybe the only other thing I would mention is that we still can kind of look into these models and figure out why they're choosing these things. And it corroborates previous research that there's been like academic research on SumZero that shows sort of the contrarian ideas do better over time. And when we built these models, we found the same thing. So we have sell side sort of targets as a factor. And we found that if a stock has more holds and sells than buys, it may actually be more likely to outperform. And our models like those ideas better, all else equal.
That's really interesting. Yeah, I think you're referring to the Wesley Gray paper, which was back in 2008, was it 2009?
Yeah, I think so.
It's been over 10 years since that paper came out. But thanks again, Jason. This has been great. Looking forward to keeping the conversation going. And again, I think it's an incredible evolution of research, that we're getting to a point where programs can actually come up with investment ideas, interpret ideas, and in some cases potentially beat the markets. So thanks for joining us.
Yeah, thank you. I think there's plenty more to talk about in the next conversation. Thanks, Divya.
Awesome. Thanks.